Hello and welcome to today's webcast brought to you by Compliance Week and Workday. I am Bill Coffin, Editor-in-Chief at Compliance Week, and I'll be your host. Today's webcast will discuss insights and lessons learned on the adoption of recent revenue recognition standards. Before we hear from our presenter, let me review the agenda. We are scheduled to go for 1 hour today. After the presentation, we will have a panel discussion with our speakers, accepting questions from the audience. You can ask your questions at any time using the Ask a Question function on the left-hand side of your screen, and I'll pose them to our guests. Questions unanswered during this hour will be addressed post-webcast. After the Q&A, I will wrap up the webcast. This webcast offers CPE credit for all attendees. Now, please disable your pop-up blockers in order to access the exam. To obtain your CPE credit, wait until the webcast is completely over and I have signed off. At that point, the final examination will be presented automatically in a separate window. If you have trouble viewing the CPE test or receiving the CPE certificate, please send an email to info@complianceweek.com. At any time during the presentation, you can download the slides from the Event Resources drop-down menu on the left-hand side of your screen. You can also hit the View Slide Full Screen button at the bottom of your screen if you wish to increase the slide size. And lastly, a Help button is located in the upper right-hand corner of your screen for assistance. Now I'd like to welcome today's speakers. It is my pleasure to introduce Eric Knackel, Senior Consultation Partner in the Professional Practice Group at Deloitte & Touche LLP. Eric has more than 25 years of experience, and he leads Deloitte's Revenue Recognition Subject Matter Team and provides guidance to audit practitioners and companies on complex financial accounting and reporting issues involving revenue recognition. Raphael Baer, Senior Manager, Revenue Recognition for Workday. Raphael has been working in revenue recognition compliance for nearly a decade and has held positions at both Oracle and PwC before joining Workday. At Workday, his focus has been on increasing operational effectiveness and improving process that will scale with the company. And finally, Tammy Cunha, Senior Director of Compliance and Reporting Revenue at JDA Software, where she oversees the subject matter experts on the implementation of Workday financials and new revenue standards. A seasoned professional, Tammy has over 15 years of accounting experience in a variety of industries, including software, manufacturing, service, and retail. Tammy joined JDA's Revenue Accounting Department 7 years ago. That's our cast of characters for today. Everybody, thanks so much for joining us. And with that, Eric, I'm going to turn it over to you to get us started. The floor is yours.
Okay, thanks very much, Bill. I guess I want to talk a little bit about some observations that we've seen with respect to ASC 606, starting with the transition method. Under the standard, entities can use either the full retrospective method or the modified retrospective method of transition. And based on our review of financial statement disclosures, it would appear that the majority of companies, in fact, in excess of about 75%, have elected the modified retrospective method of transition. Roughly 15% have selected full retrospective, and roughly 10% are still undecided. In terms of the implementation process itself, when we've looked at, when we've surveyed companies, what we've seen is that there's approximately 10% of our sample that disclose they are substantially complete with their evaluations. And despite that progress, the disclosures indicate that there's still a lot of work to be made, and about 90% of our sample disclose that the implementation efforts are ongoing. And further, there's probably only about half of our sample companies that have provided any quantification of the impact. So clearly, there's still a lot of information that isn't being disclosed, and a lot of work still being done. And I think that really, when I look at the ongoing challenges and what companies are still dealing with, I would put them largely into two buckets: operational and technical. And I think that companies tend to focus on accounting initially, but I think that looking at the accounting side of things does not really give an accurate picture of readiness. I think it's interesting that accounting implications and ramifications are the initial focus, and rightfully so, of the new standard, but what we've seen is that once companies begin to deal with the accounting implications and the broader impact to the business, the broader impact to the business becomes the area of greater emphasis. And I've heard companies indicate that it's these broader operational aspects that have them most concerned. And there's really three areas that keep coming up that I've identified on the next slide here: IT, legal, and HR. From an IT standpoint, it's really, I know this will be talked about further in our presentation, but it really comes down to, the company's current system, and is that system capable of gathering and reporting the data that's required under the new standard. But I'll save that for later in the presentation. I want to really spend a little bit more time talking about legal and HR. In terms of legal, I think the issue that comes up is, should the terms of the contractual arrangements be changed due to the new accounting rules, and specifically legal terms around termination, provisions, pricing, and enforceable obligations. And what I've seen is that a company's legal department will need to study the new standard and often will adjust its typical contractual terms going forward. And not only going forward, but also looking at those contractual provisions in terms of existing contractual terms. And do the existing contractual terms have some undesirable impacts that a company would like to address? From an HR standpoint, I think the obvious issue that comes up all the time is resources and training. And certainly implementation of the new standard is a major undertaking that will require significant resources and staff. And that goes beyond accounting. I think it's, salespeople, legal resources. And I've heard a number of companies indicate that having sufficient resources is a real challenge. But recently, we've been hearing companies talk about compensation arrangements as an HR issue related to the new standard. Many companies have various types of compensation plans or bonus plans that are tied to revenue, be it absolute revenue numbers or revenue trends, EBITDA, etc. And the new revenue standard changes how a company will measure revenue. And companies are realizing that this impacts the types of compensation arrangements or bonus plans they have, and it has a dollar impact on the company and individual. It's a real dollar impact. And I have seen the impact on compensation arrangements or bonus plans catch companies by surprise. And I think that to address that potential impact, there are basically two choices. One, a company can either try to redesign the detailed terms of the program and replicate the payouts that would have occurred under the old revenue recognition standard, or a company can maintain separate records that recognize revenue the old way for compensation purposes. And both of those options present challenges. The first option may require considerable time and effort, and legally may require approval from affected stakeholders, which can be difficult to obtain. And of course, the second option is maybe theoretically more straightforward, but it does require duplication of effort. Either way, there are challenges that a company is going to need to think through. Moving to the technical side of things, I think as companies continue to move forward with the assessment phase, either new fact patterns or variations of the fact patterns become apparent that require interpretation of guidance in the new standard. And I would say that generally speaking, I would put those into two categories: general questions and industry-specific issues. I think general questions are those that have broad implications. For example, the area of contract costs seems to be currently kind of a hot button. Questions like what costs to capitalize, the amortization pattern, the time period, but also questions around performance obligations. For example, when do you combine performance obligations and account for multiple performance obligations together, versus when would you separate those performance obligations and account for each one separately? And this can have a very big impact on the timing and or pattern of revenue recognition. And so those are what I would call general questions. But probably the greater volume of questions that I'm seeing right now is around industry-specific issues. And it's a very challenging area because previously many industries followed what might be referred to as, I'll say, industry-specific GAAP. And the new standard removes that industry-specific guidance, and by design, the new standard is supposed to provide a framework that can be applied to all industries. As it turns out, many individual industries are finding that general framework provided in the new standard difficult to apply to their specific fact patterns, and sometimes companies are left wondering how much interpretation or different judgments can be applied to their specific fact patterns in order to appropriately reflect the substance and economics of the transaction. I have definitely seen an increased level in activity as it relates to those industry-specific issues, and I think it's worth noting that the AICPA established 16 working groups organized by industry to identify and address revenue recognition issues. And while those groups have been in existence for probably well over a year, we have seen increased activity in terms of identification of industry issues in the last 3 to 6 months. And I suspect that increase, that trend in specific industry issues will continue as we move forward. Let me turn it over now to Rafael.
Great. Thank you so much, Eric. And thank you for having me on today. One of the things that I think is a common theme based on what Eric has said and general insight that we've received from other customers who are in the process of adopting is sort of the use and leverage of quality data, the source of data that is going to allow you to go through the adoption and assessment process. Part of our ability to early adopt and go through all of our evaluations is the ability to have a clear, defined source of data and having consistent data that allowed us to go make those assessments and quantify the impact on our population. One of the things that we look to is the ability to have control around our population and our testing sample, making sure that we're properly identifying the various different risks and identifying transactions that are going to be impacted by the new standard. As our process to decide to take the early adoption path, big part of that was our ability to gather that data and make those assessments. And so with the relatively short time period that it took us to go through the process of adoption, that was a critical piece in sort of making our determination. And then it also played a critical role throughout the entire adoption process as we relied heavily on our systems, on our controls, and on our ability to gather the appropriate data and then apply that data, those results against our existing data. This then brings me to the next point of being able to report. Once you've gone through the evaluation and assessment phase, being able to report on that data and assess the impact on your entire financial statements becomes much more important, and it's something that you're going to need to rely on quite a bit in terms of your go-forward process and post-adoption operations. So one of the key pieces for us was also being able to leverage some of the features that we have in being able to layer on our transactions that were impacted by the new standard, and then being able to compare and contrast sort of the impact to our financials and being able to report on those. The reporting continues to be something that we focus on, and is something that we truly underestimated in the beginning, partially due to the speed with which we adopted and having to go through many different phases of assessment. But it continues to be a big focal point for us and making sure that going forward it's something that provides value and is accurate within our systems. The other component of the entire adoption process was ability to have a system that allowed us to have accurate data and reliable data. Our product includes always-on auditing capabilities, and so that sort of made it much easier for us to implement and get through the process. Again, being able to rely on the source data and also on the data post-implementation to make sure that our workflows and our business processes were always engaged and always something that we could report on and carry forward into the future. This obviously creates efficiencies from an audit perspective, as all of the assessment and evaluation and ultimately implementation needed to be validated by not only by us internally, but also by the external auditors as well. So as I know that there's a lot of different folks out there using various systems, the ability for us to have a single system approach and the source of data has been a huge key driver to our ability to early adopt. As I alluded to earlier, one of the components of our adoption was to layer on the transactions that were impacted by the new standard and input those into our existing systems to be able to report on them. As Eric mentioned, most folks are going to be going through a modified approach for adoption, which does require you to track not only your existing transactions, but also the transactions that would be impacted under the new standard and being able to report on those. I think one of the greatest features of what we have and what we've been able to utilize as part of the final implementation stage was to keep those contracts that were impacted and modified as a separate population and layer them on top of our existing general ledger. This makes it easy not only for reporting purposes, but it also allowed us to compare the impact from pre 606 adoption to 606 adoption and determine the overall impact, and then continue to have visibility to that as we continue to operate our business going forward. So as I mentioned, as well as just the ability for us to have that dual reporting, so customers who are, or companies who are looking to adopt using the modified method, you will have the ability to not only see your existing financials, but also those impacted by the standard. The message of this bottom line here, I think, is to really focus on making sure that you have reliable data and you have a system that you can rely on that tracks the entire workflow process and business process as one clear process flow. The adoption there's a lot of moving parts. There's a lot of assessment of the different types of transactions, and I think having the ability to eliminate the noise and the distractions by different systems and the controls that are in place within those systems is something that was key to making our adoption successful and timely given the runway that we had. So with that, I will hand it over to Tammy. Thank you.
Thank you, Raphael, and thank you for having me. So I'd like to start off telling you a little bit about JDA. I'm going to spend some time on details to hopefully help you understand our complexities and give you kind of an idea of our challenges that we're facing with the implementation of ASC 606. And then I'll end on a high-level overview of where we are in our implementation. So JDA. JDA is a leader in providing software supply chain and retail software, but what does that mean, right? Our software actually helps our customers with their distribution of their products. It helps them actually shelve their products. It assists them with stocking their inventory, and then, of course, the shipping of their goods. So this slide gives you a little bit of statistics on JDA and gives you a little bit of background of our size. So we generate about $900 million revenue yearly. We have approximately 4,500 employees globally. we invoice in 30 countries and in 28 currencies. I think that's actually growing too. And we have a presence in 40 countries. So this slide is giving you a snapshot of Workday revenue key capabilities. So this slide, as you can see, it has, JDA or Workday has many capabilities, and here at JDA, we definitely use all of this functionality to the fullest. So, but what this slide doesn't actually show you is the new revenue tool functionality, which we're currently partnering with Workday to ensure that it works for all of our scenarios here at JDA. So this slide, actually, as you can see, we have various revenue streams. So we have perpetual software, we have subscriptions, which are time-based, usage-based, we have SaaS, and again, as many others that you can see listed here. So we have many of our contracts are MEA, so we have multi-element arrangements, and we deal in multi-currencies. And I can tell you that our contracts are not vanilla. So with all these complexities, we definitely need quite a bit of functionality to help us operate our business efficiently. So I want to step back. I want to take you to our implementation of Workday Financial. So when we implemented Workday, we were able to use our Salesforce opportunities to create an agreement in Aptus. JDA built an integration called JSIF that pushes all of the revenue and the billing, including our customer information, into Workday. So with this integration, we're fortunate that all of our contracts are in Workday. So as Raphael stated earlier, kind of a single system that has all of our contracts in it. So we're kind of fortunate that we have that and that we'll be able to get use that we only have one system of truth for our contracts and our contract information. So hopefully this has given you a good picture of JDA's complexity and how we use Workday functionality to help us with those complexities. So this brings me to where we are. Where are we today? So this slide is a high-level timeline of where we are today in our implementation. So in phase one, we had a dedicated ASC 606 team, and I know earlier noted on having the right people, and it has been difficult, but we have one part-time person, one full-time person, and then myself as well, which actually I'm part-time too because I have a day job, so I'm sure most of you can relate to that. And then phase two took us twice as long as we had planned. So getting our business, all of our business decisions finalized and completing our work papers was most of that time was spent in that phase two. We had planned to be done before June, but we actually just finished up in August. So we have been able to get back on track. We are nearing the end of phase three and starting on phase four, which includes our restatement of our financial statements. So as you can see, this has been a long project. We still have more to go. Kind of takes us into next year. What's not showing you is our Q1 next year, as we do have early adoption. We are early adopting as a private company January 1st, 2018. So I want to thank you, and I look forward to your questions.
Great, Tammy, thank you so very much, and thank you also to Raphael and Eric for your presentations that offered a really great overview of kind of the landscape that we're talking about here with the various trends and challenges and opportunities that everyone in the compliance community has to face on this. Now, to the folks in the audience, if you'd like a copy of the slides just presented, you can download them from the drop-down menu on the bottom left-hand side of your screen. With that out of the way, I'd like to move on to the panel discussion part of our session. As a reminder, you can submit questions, and we'll try to pose them to our guests. If you have any questions that are posed and they go unanswered, our guests can answer them after the webcast. Now, our first question, this is really for the entire group. there's a lot of uncertainty and ambiguity in interpreting and adopting new standards. Even the big four firms don't necessarily have a consensus on everything. So with that in mind, what are the top 3 things that you think one should keep in mind when it comes to partnering with your external auditors and your internal compliance team, especially concerning adopting ASC 606? Raphael, would you like to take that one?
Yeah, sure. I'll take this one first. So, one of the biggest drivers for Workday, as someone who had to go through this process very early on and be one of the first adopters, we really had to focus on this quite a bit in terms of ensuring that we assessed our different risks and different issues that we had to go through with our external auditors, making sure that we're in agreement in terms of the position that we were going in with and the expectations that they would have with us. They've been great partners with us along the way in ensuring that as some of the standard was still being established and some of the nuances were still being discussed, they really handheld us a lot through the process, and it was a very collaborative type of environment in terms of making sure we arrived at a position that was accurate. And so definitely not underestimating the time that it will take for your auditors and you to come to an understanding in terms of the certain interpretation and judgment calls that may need to be made during the process. The other piece is just making sure you're involving your internal compliance team and making sure that they're aware of the changes that are going to be happening. They're going to have a lot of work to do as well in terms of making sure that they're able to test and go through the various data that has been generated throughout the adoption process. And so making sure that they have the bandwidth and understanding of the things that are going to be coming down and impacting them. So really just setting that precedent. This is also going to drive future policy and future practices within your organization. So making sure that those are clearly outlined from the outset is going to save you a lot of time down the road.
Terrific. Tammy, same question to you.
Yeah, thank you. So, I mean, we definitely, I agree with everything Raphael said. We're having similar, we're doing similar. But I would say if I had to say 3 things and kind of bucket them, I would say meet early, meet often, and be flexible. When I say meet early, and get through your technical papers as soon as you can. That's where a lot of discussion happens between you and your auditors. Issues that you may not even have thought about come up, and you can get those resolved. And that's why I say meet often. We're actually meeting with our auditors weekly now, where we review our technical papers. We're able to ask questions. We kind of present scenarios and have some determination on how we will handle some of those under 606. And then I'd say last, flexibility. So understand that your audit firms are still working through all of their interpretations, and every company has some type of nuances that can change an interpretation. So again, I would say, meet early, meet often, and be flexible.
Thanks, Tammy. Eric, do you have anything to add?
Well, Bill, it's listening to both Raphael and Tammy. It's interesting because I share a lot of their thoughts, and of course, I look at it from a slightly different perspective, as from the auditor perspective. But certainly, I think some of the things that you heard, I would echo. Early involvement, I think, is absolutely key. Collaboration, I think you heard that. One that I would add, if I were kind of looking at a top 3 list, in addition to early involvement and collaboration, I would also say resources beyond accounting. And I go back to some of the earlier comments that I made, but I find that to think of it simply as, all we need to do is just get the accountants together, I find that oftentimes that's where we start to run into some issues about, well, wait a second, what are the contractual terms, and who really understands this? And maybe we need someone from, from legal, and maybe we need someone from the sales organization to explain exactly, maybe what's happening in practice. So I think the resources beyond accounting, I've found that to be very useful. And Bill, I think when you teed up the question, you mentioned the big four firms don't necessarily have a consensus on everything. Maybe just to address that point, I think that I think there can be differing views, as is the case when it comes to interpretations with all accounting standards. So I don't think that's necessarily unique. But I would observe that as it relates to ASC 606 and the whole implementation, the big four accounting firms really have been working very closely together, but also with the FASB, the AICPA industry groups, the SEC, and it really has been a collaborative effort to get the interested parties involved and working together to work through issues. And I think that process has proven to be very effective and continues to this point.
Perfect. Thank you. Raphael, let me ask you this. On ASC 606, if you could have started it all over again, what might you have done differently, if anything at all?
Sure. Yeah. Other than having the benefit of having a little bit more time to get implemented, that would have been definitely something I would have liked to have started earlier. But with that in mind, one of the biggest components to our just complexity during this process was just the speed that we were going at and the time that we had to adopt. I think the one of the pieces that we didn't focus on quite as much until later in the adoption phase was the reporting requirements. And again, I alluded to this earlier, but not only reporting your results, but also reporting going forward for disclosure purposes, I think are really important, and understanding how your systems are going to track, especially for those doing the dual method or the modified method, where they need to have the ability to track under both standards is really important. So understanding how your system's going to behave, how your processes are going to be built out around tracking those transactions, and then accurately reporting those transactions, I think is going to be a really key component to a lot of customers and companies, especially those using a variety of different systems for their accounting. So definitely don't underestimate this piece of the project, and start focusing on it early and discussing it early.
Yeah, thank you. I have to admit, I almost felt bad asking you that question, because I know what so much work goes into into this. Asking somebody to imagine doing it all over again seems kind of like paying for a crime you didn't commit. So thank you for your answer there. I know it's a tough question. Tammy, my next question is to you though. JDA has private equity backing from both Blackstone and New Mountain Capital. And, many private companies have similar considerations as they vie for, an IPO, they court strategic investors, and as a result, they have to be very forward-looking and agile. So as you think about transitioning to this new revenue standard, in addition to ensuring compliance, can you also discuss what some of JDA's other strategic objectives have been, and how those might have impacted your adoption approach?
Yeah, that's a good question. So I think the main area that we had to consider for our future strategies for our company is around our financials. So I think it was very important for us to have comparative financial statements. So for JDA, we actually have elected to adopt future retrospective. So we are part of the 15%, not the majority. And I think that was mainly because we wanted to make sure that at any point in time, we would be able to have comparative financial statements. The other thing was deciding to have an early adoption. So we are a private company now, and we are electing to early adopt. I think I mentioned that earlier, as of January 1st, 2018. So I think those were the main areas of consideration.
Terrific. Thank you. Eric, next question is for you. Could you comment on some of the key issues that you're seeing on this particular standpoint, specifically as it regards to the accounting space?
Sure. You know, I think obviously the list of specific issues, you know, when I was talking about technical issues earlier, and there's some that are more broad or pervasive around, for example, performance obligations or significant financing components, and others that are more industry specific. You know, that list can be long, and in fact, it is long. But you know, I think what I would probably highlight, you know, at a training that I was involved with less than 2 months ago, one of the questions to the participants was, what do you view as the most significant challenge with respect to the new revenue standard? And by far, the most common response was balancing principles, in other words, balancing a principles-based judgment with expectations of consistency and comparability. And I personally think this is proven to be one of the most challenging aspects of the new standard. And, you know, if you keep in mind how the new revenue standard came about, there was, and I say was, but it's the current situation in which we operate today, there's no one single revenue standard. Instead, you know, different industries follow different guidance. So, for example, if you were selling software, the literature you looked at was very different than the literature a company might be looking at if they were, say, building a bridge or selling consulting services or manufacturing cars. The new revenue guidance was developed specifically to do away with industry-specific rules and instead provides a single framework that could be applied by all industries, or I should say by all companies, regardless of industry. And this, you know, also keep in mind the standard was developed jointly between the FASB and the ISB. And so I think it's, you know, I think it's widely acknowledged that the new revenue standard will involve the application of significant judgments. And likewise, many times I've heard the new revenue standard being described as principles-based as opposed to rules-based. But at the same time, while the new standard will involve more judgment and is principles-based, the new standard also provides a framework that is to be used consistently to develop appropriate judgments. And said another way, you know, a principles-based standard that involves significant judgment areas shouldn't be viewed as a free invitation, if you will, to develop any accounting policy that a company believes makes sense simply because it represents that company's judgment. And so I think therein, you know, I believe that therein lies, you know, one of the biggest challenges of the new standard that I'm seeing right now with a number of companies across industries. And to break it down in a very practical way to look at it, the question becomes this. When is it okay to have different accounting treatments as a result of different reasoned judgments versus when is it not okay to have different accounting treatments because there are a number of situations when two companies have similar fact patterns and that should result in a similar accounting treatment. And I think that's really a fundamental issue. And I'm seeing this notion of, you know, differing judgments versus consistency emerge as a frequent theme that companies cite as proving to be extremely challenging as they work through implementation.
Oh, excellent. Thank you, Eric. Raphael, Workday has been live on ASC 606 for more than 2 quarters now. Can you share about some of the, you know, the learnings and the tips on the stabilizing phase of all this? Specifically, what are some of the key differences that you see between, you know, now ASC 606 versus before ASC 605?
Sure. You know, thinking through that question, I think some of the biggest differences are really centered around training and coaching, not only our own revenue team, making sure that, you know, it's a slightly different way of thinking and slightly different process that we have to go through in order to arrive at the final conclusion. It's not to say that our ability to arrive at that conclusion is not correct or not accurate. I think just the thought process that you go through is a little bit different. So needing to sort of re-educate and get everybody at your organization used to thinking through the different frameworks to arrive at that final conclusion. You know, Workday, we've been really focused at trying to focus in on that and make sure that we develop the appropriate policies and practices and educate our teams. And that goes beyond, you know, just the revenue recognition team. As Eric has alluded to, there's a lot of different stakeholders in this where legal and some of the HR teams may need to be educated as well, just to make sure that they understand the different implications of the decisions that they make. You know, one of the things that we continue to just focus on a regular basis is any changes to compensation plans, that we're continuously evaluating those and making sure we get visibility into the changes that would impact how they're capitalized or which amounts are capitalized. And so that's definitely one of the changes, and I don't know that it's any different from prior changes in standard or how it's been applied. And so, you know, every time you have this significant shift, I think it takes a little bit of time to gain traction, and making sure that everybody's aware of the pitfalls and having regular conversations with your teams is really important. And so we continue to try to do that. I think one of the other components would be really just during the adoption phase and coming out of it, you know, you had the benefit of hindsight, right? In assessing certain types of transactions, you maybe were able to understand, you understand your general business practices and how you've applied those in the past. And so when you've made the determination of certain types of transactions, I think certain decisions were made a little bit easier during the adoption phase. And I think now, again, kind of bringing it back to the setting policy and precedent piece that I mentioned earlier, is focusing on how you're going to set up a framework so that your team is consistently applying the different types of scenarios and situations that may come up and understanding what your outcome is going to be, and then also making sure how you understand how that's going to impact your financial statements, whether that's, you know, looking at contract modifications or the risk of contract modification at some point in the future, and also looking at things like combined contracts and things like that you need to evaluate with a little bit of a different perspective.
Raphael, thank you. So Tammy, I have a question for you then. You know, JDA has over 4,000 customers worldwide, and it operates in some 30-plus countries across North America, Europe, Middle East and Africa, Latin America, Asia, pretty much anywhere except Antarctica, really. You know, can you share about how you've adopted this new standard on a global scale and in a synchronized fashion? Because as we all know, in the compliance world, you know, going global is so much easier said than done. And so what particular challenges has this posed to you? And perhaps on the flip side, have you discovered any opportunities that have arisen as you've addressed those challenges?
Yeah, no, it's been a lot. So I can say a lot of meetings. That's where it has happened. A lot of meetings and at different times, right? So early on, we actually established a global project team, and that team actually consists of most of them consist of our revenue accountants and our revenue recognition specialists. So that team actually has started meeting about monthly, but then as we work through our technical papers and how we're going to handle many of our scenarios, we actually now meet weekly. So that team is actually helping us more with the accounting functionality, operationally, more information on how accounting is going to handle it. But we also created a cross-functional team, excuse me, and I know that Raphael and Eric talked a lot about this, and that team actually has all of our departments. I mean, HR, tax, IT, our deal desk. I mean, you name it. Pretty much every company. Again, all our departments, we do have, they are global. So we meet with that cross-functional team quarterly to ensure that, communications kind of keep them up to speed on what's going on. But we also have to have some specific teams, right, some specific meetings. So, with sales, when we were trying to figure out what our SSPs were and how we were going to approach that, we had, biweekly meetings with the deal desk, the sales team, consulting, our support team, and we still do meet with them quite often, but more when you're working through that first part, like I was saying earlier in our phase 2, for that technical piece of it and your technical papers, you really have to get their input, because a lot of things that you'll be writing in your technical papers is how we actually go to market, how we go to business. That is it's probably where you'll get most of that information when you're in those meetings with those folks. And then, of course, as we need to discuss further and kind of deep dive, we don't want everybody in the room, so we're actually meeting at a minimum quarterly with folks like tax, our HR team, and our FP&A team. So those meetings will come up, as needed, as I said, and then be able to make, any decisions that we need to make, and we meet with them. So again, I'd say a lot of meetings, and some really late and some very early. So that's how we've been able to adopt globally. And I think the opportunity, some of those opportunities, I think it has actually, for me personally, has been able for me to learn a lot more about the company, actually, and how we do go to market and some of our strategies that we have, which really help, again. And I think it actually even helped our audit team when we came back. I think certain things, they've been auditing us for many years, but when we came and said, well, this was, kind of our strategic way how we look at things, I think that actually has helped as well. So I think it's been a great learning opportunity for many of us.
Tammy, you just raised a very interesting point in your last comment there about how this is giving you an opportunity to learn a whole lot more about your company and about the market. And that kind of dovetails with, a common refrain I hear from compliance officers all over, whether they're dealing with this challenge or another challenge, which is, one of the things that has been a recipe to their success as a compliance professional has been really understanding the nature of the business that they're in, understanding their company's specific needs. You can't do compliance in a bubble. You have to be wholly integrated with every aspect of your organization to really understand. So it was interesting to hear you say that, because that's kind of proof positive of that truism. So it was very interesting for you to get into that a little bit. I do have a follow-up question. Both Workday and JDA, they're both, they're in technology. They have a portfolio of business models ranging from subscription to usage to project-based pricing models. And JDA sells both on-premise and software as a service. So, as many in our audience here also have, similarly complicated monetization models, I was wondering if you could kind of share some of the challenges and things you've learned as you've adopted, this new standard across, multiple monetization models.
Sure. So we've had so many challenges. I guess one of our largest challenges, though, that we had was, as I discussed, completely keeps coming up is our complexities. So not only do you have, so many scenarios to our company with all the lines of business and all of our revenue streams, but also, the complexities in our contracts. We just have a lot of verbiage and things that we need to go back and look at. So I think if that's definitely one area that, again, it took us a lot longer to understand and get involved in. And if I was to, recommend people, identify, as many of those scenarios up front and kind of assessing them. And what that will help you with, though, is that, when you start working through your technical papers and start talking with your auditors, you'll be able to identify most of those scenarios. And again, you can't go with every one-off. You'd be there forever. So, kind of taking that, 80-20 approach. So kind of going in and saying, okay, 80%, this is kind of where 80% of my scenarios lie, and that's where I'm going to focus my time. And these 20%, as they come up, and not that we haven't touched on those, because we have, but not so much of a deep dive. Yeah. And for us, I think another one of our challenges was standalone selling price, the SSP for software, our perpetual software. So, today we use the residual method. So for our business folks, as well as in accounting, this is all new. So this kind of took twice as long as expected as well, because when we started, trying to explain what that means and how that works. I mean, for our consulting folks, they're used to this, right? They DSO or support as well. So other lines of business, they're very used to this methodology. But our software folks, they were not used to understanding that we actually have to sell, standalone selling price. We need to figure out what the ranges are, pulling our historical data from it to figure out, what would be those appropriate ranges, and then getting those ranges through our auditors to make sure that we stay compliant, and that, when we do our audit, we actually will be, be able to be signed off on our audit. So I would say for everybody, start that area as early as possible. So, write down all your scenarios, kind of work with, again, we were working with our revenue recognition specialist team because they see those every day. So they see all the contracts. They kind of give you a better idea of, what are your scenarios? In my, I was over the revenue accounting team. I've been over billing, contracts, all of those teams. But the revenue recognition specialists who actually look at those contracts every day, they're going to be the ones that will give you most of that information. So I know collaboration keeps coming up in our discussion, and I think that's really, bottom line what this comes up to. You can't imagine how many people you have to talk to in all the meetings. That's pretty much where I live my life. Life is in meetings. So, I would start early, and then, again, I think Eric mentioned this too, is getting third-party help. If you need to get third-party help, you're running out of, runway here. So if you need to get somebody in to help you with any of this, we definitely, I would say that that's something you should probably do early on, and try to sign them on and get that help in the door before you run out of time.
That's a terrific point, Tammy. And to that point, and speaking of third-party help, Eric, as you listen to Tammy talk through that last answer, so did anything really jump out at you from an auditor's perspective?
There are some things that have jumped out. It's interesting for me to listen to both Tammy and Raphael. Tammy was talking about, the opportunity, and I think, around the accounting standard. I think that often the standard is looked at as as kind of, I'll say, a compliance obligation, something you have to do for compliance purposes, and obviously that's true. It is a requirement that companies need to follow. But what I've seen is that Tammy was talking about vendor-specific objective evidence, for accounting purposes, but a lot of times some of these accounting rules have played a large role and maybe even driven some a company's business practices, how they go to market, how they price things. And so I think that the new accounting rules afford companies an opportunity to take kind of a fresh look at how they go to market, how they price their products, how they approach customers, how they bundle different types of products or services, and really take a fresh look at that and say, we no longer have maybe some of the restrictions that we used to have, and what do we think would make the most sense from a business standpoint, and not necessarily have the accounting drive the business, actually have the business be what companies think makes the most sense, and then let the accounting follow, and really, use revenue management as a tool to then decide, how to allocate resources and what makes the most sense. And so even though it's the accounting standard that might be the impetus for certain changes in the business, I think that there are opportunities for changes. Another point, Bill, that struck me as I was listening to both Raphael talk about different aspects. One of the points he made that I think is very interesting is around disclosures. I've taught a number of different trainings around ASC 606, and disclosures is often the very last topic that's discussed. And a lot of times, candidly, in training sessions, if we kind of run over, disclosure gets somewhat cut off, and you don't really talk about it too much. And I think there is a natural tendency to think that, well, if we get the accounting right, if we get everything else right, then the disclosure will just kind of follow. And the way I describe it is that oftentimes you think of the accounting as kind of like a math problem. And then the disclosure is, well, if I've solved the math problem, then the disclosure is just a matter of showing my work for that math problem. But in this particular case, for ASC 606, what companies have realized as they go through the process is that the disclosure is almost like, at times, a separate math problem all unto itself. It's not a matter of just showing the work that you already have. It's not a matter of presenting information that you've already gathered, but at times it actually requires obtaining additional information and presenting that information for disclosure purposes when you hadn't obtained the information previously. So it's like a whole separate exercise that can be very complicated, requires IT resources and of course time, and I think it's catching companies by surprise that they just assumed they were kind of done, but the disclosures proved to be a very challenging exercise all by themselves.
Excellent. Well, Eric, thank you. And you had mentioned time, and that reminds me, I think we're almost out of it. So I'm going to thank you for your answers and to the entire panel for a very informative session today. Again, our guest panelists were Eric Knackel, Partner, Professional Practice Group with Deloitte & Touche, LLP, Rafael Bayer, Senior Manager, Revenue Recognition for Workday, and Tammy Cunha, Senior Director, Compliance and Reporting Revenue with JDA Software. And of course, a very special thanks to our friends at Workday for making this webcast possible. This webcast has been recorded and will be available later today to Compliance Week subscribers on our website under the Webcast tab. If you would like to learn more about subscribing, please contact us at info@complianceweek.com. Once again, to obtain your CPE credit for this presentation, please disable your pop-up blockers in order to access the exam. The webcast will close automatically, and the final examination will be presented in a separate window. If you have trouble viewing the CPE test or receiving the CPE certificate, please send an email to info@complianceweek.com. This concludes our webcast for the day. I'm Bill Coffin, and on behalf of Compliance Week, thank you again for joining us. Bye now.